Welcome to IRAS's seminar on Singapore's Overseas Vendor Registration for Goods and Services Tax, OVR in short. This seminar explains the OVR rules and highlights what overseas suppliers and marketplaces need to do in order to comply. We will start with the policy rationale for introducing taxation on imported services. Imported services will be subject to Goods and Services Tax, or GST, with effect from 1st January 2020. This ensures that Singapore's tax system remains fair and resilient in the digital economy, and that all services consumed in Singapore are subject to the same GST treatment, whether the services are procured from local or overseas suppliers. A reverse charge mechanism will apply to tax cross-border business-to-business or B2B services, meaning services imported by GST-registered businesses. However, reverse charge will not work for cross-border services imported by non-GST registered entities such as the individual consumers in Singapore. Hence, an overseas vendor registration regime will be implemented where the overseas supplier is required to register for GST and charge GST on cross-border business-to-consumer or B2C digital services supplied to Singapore. Throughout this seminar, the term OVR regime will be used to refer to the Overseas Vendor Registration Regime. Let us look at the features of the OVR regime that will be covered in this seminar. You may find timestamps to the various segments of this seminar in the video description below. First, we will explain the OVR Registration Threshold, which tells you when overseas suppliers need to register with Singapore's tax authority, IRAS. Next, we will look at the scope of digital services under OVR, followed by who will be subject to OVR, with a focus on the role of electronic marketplaces. We will then explain the Transitional Registration Rules and features of the Simplified Pay-Only regime that most overseas suppliers will be registered under, followed by the rules on determining customer belonging status and whether a supply is a B2C supply. Lastly, we will explain the time and value of supply, including the transitional time of supply rules, and end the seminar by recapping what overseas suppliers and marketplaces need to do to be compliant with Singapore's tax rules. As an overseas supplier, you must register for Singapore's OVR regime if your turnover exceeds certain thresholds. You will exceed the threshold if, in a past calendar year, your global turnover exceeds 1 million and you make supplies of digital services to non-GST registered customers in Singapore exceeding 100,000. It is also important to note that B2C supplies refer to supplies made to non-GST registered entities, which are mainly individual consumers in Singapore, but also include businesses that are not registered for GST. If you are liable to register, you must do so within 30 days of the end of the calendar year. Alternatively, you as an overseas supplier may be liable to register on a prospective basis at any time if you expect your global turnover and supplies of digital services to non-GST registered customers in Singapore to exceed 1 million and 100,000 respectively for the next 12 months. Persons liable for GST registration are required to apply within 30 days of the day they make the projection or forecast. Moving on to the scope of digital services under OVR, GST applies to supplies of digital services made by overseas suppliers to non-GST registered customers in Singapore. One important thing to note is the scope of services under the OVR regime is narrower than the services subject to reverse charge. Reverse charge encompasses all imported services other than some specific exceptions, whereas only digital services are within the scope of the OVR regime. Digital services are defined as services which are supplied over the internet or an electronic network, and the nature of which renders their supply essentially automated with minimal or no human intervention, and impossible without the use of information technology. There are two key aspects of this definition. The first is, the services must be supplied over an electronic network, and the second is that the supply must be automated with minimal or no human intervention. Considering these key aspects, legal services where advice from the lawyer is communicated via email will not fall within the definition of digital services under OVR. Legal services would in most cases involve a significant element of human intervention, as a lawyer will have to analyze the case facts before providing the advice. Hence, even if the advice is provided by electronic means, it will still not fall within the definition of digital services. When assessing whether a supply of digital services is within scope of Singapore's OVR regime, overseas suppliers should carefully examine the services they provide and consider whether an element of human intervention is present. Besides the definition of digital services, please also look at the list of included and excluded digital services under the 7th Schedule of the Goods and Services Tax Act. This list clarifies the taxability of all the common types of digital services and makes it easy for overseas suppliers to ascertain whether their services are in or out of scope. Examples of digital services which are within scope of tax include downloadable digital content such as mobile applications, e-books, and movies, online subscription-based media such as music and video streaming services, software programs, and electronic data management services such as website hosting and cloud storage services. Please also note that support services performed via electronic means for arranging and facilitating the completion of transactions will be within scope. Examples include service fees charged by accommodation listing platforms to guests for the arranging of accommodation, and commission charged by electronic marketplaces to non-GST registered merchants and app developers who make sales of digital services through the marketplace online platform. To maintain parity with services provided by local suppliers, imported digital services that may be zero-rated had they been supplied from Singapore are specifically excluded under the 7th Schedule. These are namely cross-border telecommunication services and internet advertisements circulated substantially outside Singapore. Similarly, imported digital services that may be exempt are excluded from the scope of tax under OVR. It is important to note that while the list of included and excluded digital services under the 7th Schedule is fairly comprehensive, it is not meant to be exhaustive. If overseas suppliers make supplies that are not within the list, they should still check whether their services fall within the general definition of digital services. Next, we will look at an example of Company A, an accommodation listings platform established in Germany. Company A aggregates accommodation availability from accommodation providers worldwide on its website and allows customers to search and book accommodation. Upon each confirmed booking, Company A charges a service fee to the accommodation providers that list their property on its website and a booking fee to customers. As the service and booking fees charged relate to support services provided to facilitate the booking of accommodation and are performed via electronic means, these fees fall within the definition of digital services and are within the scope of Singapore's OVR regime. For service fees charged to non-GST registered Singapore accommodation providers and booking fees charged to non-GST registered Singapore customers, the fees are subject to GST as they are within scope and supplied to non-GST registered persons in Singapore. For service and booking fees charged to overseas persons, the fees are outside the scope of the OVR regime as they are supplied to persons that do not belong in Singapore. Lastly, for service and booking fees charged to GST registered Singapore persons, the GST registered recipient of the service should perform reverse charge where required instead. Next, we will cover a concession involving non-digital services supplied together with digital services. As explained in the previous slides, non-digital services are not within the scope of OVR. However, where the supply of non-digital services is ancillary to or part of a supply of digital services, overseas suppliers may request to also charge GST on the non-digital portion of their supply of services. For example, where on-site training services are provided together with the supply of electronic software to non-GST registered customers in Singapore, the overseas vendor may charge GST on both the on-site training services and software if it has obtained approval from the comptroller to do so. This option was introduced in response to feedback received from overseas suppliers and aims to simplify compliance for overseas suppliers who find it difficult to apportion the value of a bundled supply between non-digital and digital services. To apply this option, overseas suppliers should write to IRAS with their business scenario and seek approval via a ruling. Next, we will look at who will be subject to OVR. Two types of entities will be subject to OVR, namely, overseas suppliers whose belonging status is outside of Singapore, meaning the supplier has no business or fixed establishment in Singapore. Local and overseas electronic marketplace operators, where the electronic marketplace is regarded as the supplier. Electronic marketplaces are marketplaces or platforms that are operated via a website, internet portal, or other type of electronic interface, but excludes payment processors and internet service providers. Electronic marketplace operators are regarded as a supplier of digital services if any of the 5 prescribed conditions are met. The first condition is the marketplace authorizes the charge to the customer, meaning the marketplace communicates the liability to pay to the customer and influences whether or at what time the customer pays for the supply. Most marketplaces would be regarded as a supplier due to this first condition. For this condition to be met, it is not necessary for the electronic marketplace itself to collect or receive the payment, or be involved in the entire payment process. For example, to authorize the charge, the electronic marketplace may only initiate the process by which the customer is charged, including situations where the electronic marketplace website connects the customer to a third party who processes the payment. The second condition is the marketplace authorizes delivery of the supply to the customer. The marketplace may deliver the item itself or notify a third party to commence delivery on its behalf. The third condition is the marketplace sets the terms and conditions under which the supply is made. The marketplace may have influence over pricing, require acceptance of specific payment or delivery methods, or provide customer support or own customer data. The fourth condition is the documentation issued to the customer identifies the supply as made by the marketplace. This includes receipts, invoices, or information displayed on marketplace website. The fifth condition is the marketplace and merchant contractually agree that the marketplace is responsible for GST obligations. Considering the conditions in totality, most electronic marketplaces would be regarded as the supplier, except platforms that purely provide listing services. To illustrate this, we will look at an example in the next slide. For this example, electronic marketplace A is the operator on an online platform that sells phone apps on behalf of underlying app developers that utilize its platform. On the other hand, electronic marketplace B is a platform that provides listing services to suppliers, and the terms of the supply are privately arranged between suppliers and their customers. We will also assume that the last two conditions are inconclusive. In other words, from the invoice issued, we are not able to tell who is making the supply, and there is no agreement that the marketplace is responsible for GST. Looking at the first three conditions, when a customer purchases an app from electronic marketplace A initiates the charging process and receives payment from the customer. Marketplace A delivers the app to the customer's mobile phone once payment is successfully processed, and Marketplace A provides sales support for the customer's purchases through the marketplace and sets the return policy. Hence, Marketplace A is regarded as a supplier of digital services made through its platform. In contrast, Electronic Marketplace B is a platform that purely provides listing services. For a listed item, payment and delivery is separately settled or arranged between suppliers and their customers, and Marketplace B does not set any terms or conditions under which the supply is made. Hence, Marketplace B will not be regarded as a supplier of digital services made through its platform. So what should an overseas marketplace operator take note of if it's regarded as a supplier of services made through its platform? If regarded as a supplier, in addition to its own digital services made directly to non-GST registered customers in Singapore, the marketplace operator should also include supplies of digital services made by overseas suppliers through its marketplace to non-GST registered customers in Singapore in computing the global turnover and digital services registration thresholds. This is of 1 million and 100,000 respectively. Where GST registered, the marketplace operator should charge and account for GST on such supplies made through its marketplace, instead of the underlying suppliers. What about a local electronic marketplace operator that is regarded as a supplier of services made through its platform? If regarded as a supplier, in addition to its own domestic taxable supplies, the marketplace operator should also include supplies of digital services made by overseas suppliers through his marketplace to non-GST registered customers in Singapore as part of his total supplies in determining his GST registration liability under the Domestic Registration Rules. In other words, the 1 million domestic registration threshold applies to local marketplaces instead of the 100,000 imported digital services threshold. Where GST registered, the marketplace operator should charge and account for GST on such supplies made through its marketplace, instead of the underlying suppliers. The following example illustrates the difference between an overseas and local electronic marketplace when it comes to GST registration. Overseas Electronic Marketplace B has an annual turnover in 2020 of 5 million. In that same year, sales of mobile applications by overseas application developers through Marketplace B to non-GST registered customers in Singapore amounted to 80,000. Marketplace B also made supplies of support services of 30,000 to non-GST registered mobile application developers belonging in Singapore for facilitating sales through its platform. Marketplace B is required to register as its global turnover and supplies of digital services to non-GST registered customers in Singapore for 2020 is 5 million and 110,000 respectively, which exceeds the registration thresholds of 1 million in global turnover and 100,000 of digital services to non-GST registered customers in Singapore. Marketplace B is required to submit its GST registration form by 30th Jan 2021. Local Electronic Marketplace C's taxable turnover in 2020, inclusive of the commission it earns, is 950,000. In that same year, sales of mobile applications by overseas application developers through Marketplace C to non-GST registered customers in Singapore amounted to 80,000. Marketplace C is required to register as its combined turnover for 2020 is 1.03 million, which exceeds the domestic registration threshold of 1 million. Marketplace C is required to submit its GST registration form by 30th January 2021. Having looked at the implications for electronic marketplaces, we next examine the implications for overseas suppliers making sales through the marketplaces. Because digital services made by overseas suppliers through a marketplace that is regarded as a supplier are deemed to be the marketplace supplies, such supplies are disregarded for the purposes of assessing whether the overseas supplier itself must register for GST. To illustrate this, we look at the diagram. In this example, an overseas software developer has a global turnover that exceeds 1 million in 2020, and it supplies 50,000 of digital software sales directly to Singapore consumers through its website. The overseas software developer also sells the software through ABC Services, an overseas marketplace, and made 100,000 of digital software sales to Singapore consumers through ABC Services in 2020. The overseas software developer is not required to register under the OVR regime because the supplies that are made through the marketplace, which amounts to 100,000, are disregarded for registration purposes. The remaining supplies of digital services the software developer directly makes, which amounts to 50,000, is lower than the threshold of 100,000. Instead, the marketplace, ABC Services, would have to register and account for GST on the sales it facilitates. Having explained the rules applicable to electronic marketplaces, this slide explains what are the supplies that must be accounted for by a typical marketplace, bearing in mind the scope of digital services under OVR. Overseas Marketplace Z facilitates the sale of mobile apps to consumers C in Singapore on behalf of overseas supplier B and local supplier A. If registered for GST, Electronic Marketplace Z is required to charge and account for GST on the supplies of mobile apps that overseas supplier B makes through the marketplace, which is represented by the supply in red. Additionally, since Marketplace Z also provides support services to local suppliers for facilitating sales made through its platform, it has to charge and account for GST on the facilitation services provided to local supplier A, as supplier A is not registered for GST. This is represented by the supply in blue. Next, we will discuss one last concession that marketplaces may apply. To facilitate compliance, the marketplace operator may seek the controller's approval in writing to charge and account for GST on B2C digital services made on behalf of both overseas and local suppliers through the marketplace. This concession effectively allows marketplaces to charge GST on all B2C supplies made through their platform without having to determine whether the underlying supplier belongs overseas or in Singapore. The supply of services is deemed as two consecutive supplies. The first leg of the supply being a supply of services at the selling price from the supplier to the marketplace, which is standard rated if made to a local marketplace and zero rated if made to an overseas marketplace. The second leg is a supply of services from the marketplace to the customer in Singapore. The deeming of the supply as two consecutive supplies allows local GST registered suppliers to claim input tax incurred in making these supplies. To prevent the incidence of double taxation, where both the supplier A and electronic marketplace operator Z charge and account for GST on the same supply of digital services to the same end customer, the marketplace operators must either agree with the suppliers and inform them that the marketplace operator will be accounting for GST on the digital services made through its marketplace, or maintain contractual agreements with the suppliers to reflect the updated GST obligations. To illustrate what happens if the concession is exercised, assuming a selling price of $100, the local underlying supplier A will account for GST of $7 on its supply to local marketplace Z if A is GST registered. If A is not registered for GST, it will not need to account for GST on its supply to Z. Local marketplace Z will claim GST of $7 charged by A, assuming A is GST registered, and Z will account for GST of $7 on its supply to consumer C. To address concerns that supplier A may not have enough time to issue tax invoices to marketplace Z, supplier A will not need to issue a tax invoice to marketplace Z. Instead, supplier A and marketplace Z are allowed to support their sales and purchases, respectively, using sales listings of the digital services supplied by supplier A through marketplace Z. Such sales listings or summaries are typically provided by marketplaces to their underlying suppliers on a regular basis. Next, we will explain the Transitional Registration Rules. Overseas suppliers are required to check if their liability to register for GST arises in 2019. An overseas supplier's liability to register for GST arises in 2019 if at any time on or before 31st December 2019, it is able to reasonably forecast that its global turnover and supplies of digital services to non-GST registered customers in Singapore for the 12-month period of 1st January 2020 to 31st December 2020 will exceed the relevant thresholds. If the earliest date that an overseas supplier is able to make such a forecast falls on or before 22nd October 2019, the overseas supplier must notify IRAS of its registration liability by submitting its registration form by 1st November 2019. The overseas supplier's effective date of registration will be on 1st January 2020. However, if the earliest date of forecast is from 23rd October 2019 to 31st December 2019 instead, the overseas supplier must submit its registration form to IRAS by 31st December 2019. For such cases, the overseas supplier's effective date of registration will be on 1st February 2020 or earlier. Overseas suppliers are strongly encouraged to register on time to avoid any penalties from failing to notify IRAS of their GST registration liability by the due date. We will now explain the features of the simplified pay-only regime that most overseas suppliers will be registered under. Overseas suppliers under the pay-only regime do not need to appoint a local agent to handle their tax matters. They also do not need to provide any security deposit unless the overseas supplier is registering on a voluntary basis. Overseas suppliers that are not required to register may do so on a voluntary basis if they make supplies of digital services to non-GST registered persons in Singapore. However, Such voluntary registrations may be subject to additional conditions imposed by the controller. Overseas suppliers under pay-only regime will also file simplified returns with only 5 boxes in the GST returns. The other boxes in the GST return will be deactivated. Box 15 is only applicable to electronic marketplaces, and marketplaces should fill up Box 15 with the value of supplies made by the marketplace on behalf of underlying suppliers utilizing their platform. The simplified returns will be filed on a quarterly basis with payment due within 1 month from the end of each accounting period. It is important to note that input tax claims are not a feature of the simplified regime. Although input tax claims are not allowed, overseas suppliers may be in a net refundable position if downward GST adjustments arising from credit notes exceed supplies made in a relevant accounting period. In such cases, the net GST refundable will be retained as credit for offset against GST payable in future periods. However, subject to the controller's approval, overseas suppliers may request for net GST to be refunded by writing in with the circumstances for the controller's consideration if they are willing to bear the associated remittance charges. Overseas suppliers are not required to complete a GST F7 to correct GST returns that have been filed. Instead, a concession has been granted to allow overseas suppliers to correct any errors made in their next GST return. However, businesses must inform the controller in writing if they make any upward adjustments to sales more than 1 year from the statutory filing deadline, as penalties will apply. We have also made bad debt relief available to pay-only persons. Bad debt relief is available upon completing the self-review checklist with GST refundable held as credit. Overseas suppliers will make the claim in Box 11 of their GST returns, and Box 7 will be automatically populated with the claimed amount. Box 11 is the box to claim bad debt relief, and Box 7 is the box to claim input tax. For invoicing and price display, there are no additional invoicing and price display requirements required of overseas suppliers beyond their usual business practices, and the record-keeping rules are generally similar to the rules for domestic GST-registered businesses. Overseas suppliers must maintain proper business and accounting records for at least 5 years and make available upon request supporting documents, including sales listings, invoices issued, payment evidence, and customer information such as the customer's GST registration number. However, overseas suppliers are only required to maintain such records for supplies made to customers in Singapore. The overseas suppliers are not required to maintain records on supplies made to overseas customers for the purposes of Singapore's OVR regime. Lastly, overseas suppliers that are certain they will not exceed the global turnover or digital services registration thresholds for the next 12 months may apply to cancel their GST registration. Next, we will explain the rules for determining customer belonging status. Generally, a customer that is a corporate entity belongs in Singapore if the business or fixed establishment that is most directly concerned with the supply is in Singapore. If the customer is an individual, the customer belongs in Singapore if his usual place of residence is in Singapore. However, given that digital services are transacted over the internet with limited information available, as a concession, overseas suppliers may instead maintain 2 pieces of non-conflicting evidence to determine their customer's belonging status. The 2 evidence pieces should consist of 1 payment proxy and either a residence or access proxy. We specifically require a payment proxy to be maintained as it is the hardest piece of evidence to falsify. Examples of payment proxies include the customer's credit card information or bank account details. Examples of residence proxies include the customer's billing address or residential address. Lastly, examples of access proxies include the customer's IP address or the mobile phone country code if the customer is making the purchase using a mobile phone. As explained in the previous slide, the 2 evidence pieces maintained by overseas suppliers should consist of 1 payment proxy and either a residence or access proxy. However, if the payment proxy is not available or contradicts the other proxies, the overseas supplier may instead maintain 2 pieces of non-conflicting evidence consisting of a residence and access proxy. Example 4 illustrates how an overseas supplier can utilize the proxies to determine the belonging status of a customer. In example 4, an Australian resident visiting Singapore purchases and downloads a movie digitally from overseas company D, which is registered under the OVR regime. The customer's IP address, the access proxy, indicates that he belongs in Singapore. However, the customer's billing address, the residence proxy, indicates that he belongs in Australia, which matches with the customer's credit card information, the payment proxy provided. Hence, Company D concludes that the customer belongs in Australia and does not charge GST on the sale of the movie. Moving on to the rules for determining whether a supply is made to a non-GST registered customer, by default, overseas suppliers may treat their services as supplied to non-GST registered customers unless they receive information indicating otherwise. Hence, GST registered customers are responsible for providing their GST registration number to overseas suppliers. The overseas supplier must provide a way for GST registered customers to furnish their GST registration number to them. For example, the overseas supplier may add an optional field for GST registered customers to fill up during the payment or checkout process. For GST incorrectly charged on supplies made to GST registered customers, customers should seek a refund from the overseas supplier instead of claiming the input tax charged. Lastly, penalties have been legislated for misrepresentation of GST registration status and belonging status by customers to deter potential fraud. Next, we will explain the time and value of supply rules for OVR transactions. Overseas suppliers will need to account for GST based on earlier of the date that payment is received or the date of issuance of any document that serves as a bill for payment. This is largely similar to the normal time of supply rules, but because overseas suppliers are not required to issue invoices, any equivalent document that serves as a bill for payment will trigger the time of supply. Monetary consideration received by the overseas supplier consists of the value of supply and GST chargeable on the supply. If the supply is not for a consideration, or is for a consideration not wholly consisting of money, then value of supply will be the open market value of the supply. Overseas suppliers must convert any foreign currency denominated supplies to Singapore dollars using an acceptable exchange rate and account for GST on the Singapore dollar equivalent. For administrative ease, we allow overseas suppliers to adopt the prevailing exchange rate at the time of supply, the end of the taxable period, or the time of filing the GST return. The adopted time period must be consistently applied on all supplies of digital services for at least 1 year. The sources of acceptable exchange rates are stated in Appendix A of the e-tax guide, GST exchange rates for GST purpose. Alternatively, overseas suppliers may write in for approval to adopt in-house exchange rates based on other sources, as stated in the e-tax guide. We will now explain the special transitional time of supply rules that apply to transactions made by overseas suppliers that straddle the implementation date of 1st January 2020. There are two sets of transitional time of supply rules, one for discrete supplies of digital services and the other for continuous supplies of digital services. A discrete supply of digital services straddles the implementation date and is subject to the transitional rules when invoice is issued on or after 19 February 2018 but before 1st January 2020, and performance of services and payment received occurs on or after 1st January 2020. Examples of discrete services include the one-off supply of digital contents such as e-books, apps, or software. Additionally, the reason why the transitional time of supply rules only applies to transactions on or after 19 February 2018 is because this is the date of the Budget 2018 speech, where it was announced that GST would be imposed on imported digital services. Invoices issued and contracts or agreements made before this date are assumed to be issued or made for genuine business purposes. The transitional rules prevent avoidance of GST by the issuance of invoices upfront before the implementation date of OVR, where payment is received or services are actually performed after the implementation date. For discrete supplies of services that are subject to the transitional rules, GST is chargeable to the extent of the lower of the value of services performed or value of payment made on or after 1st January 2020. The portion of the service which GST is applicable on should be filed in the overseas supplier's first GST return. To illustrate the transitional rules for a discrete supply of services, we will look at examples 5 and 6. Both examples involve the supply of digital software of $100 made by an overseas supplier that is registered under the OVR regime with effect from 1st January 2020. In example 5, invoice for the supply is issued in December 2019 and full payment is also received in December 2019. Although the service is only performed after the implementation date of 1st January 2020, the transaction is not subject to GST as the lower of the value of services performed or payment made on or after 1st January 2020 is 0. In example 6, invoice for the supply is issued in December 2019. However, only $40 part payment is received in December 2019, with the remaining $60 received after the implementation date of 1st January 2020. The service is also only performed after the implementation date of 1st January 2020. In this case, $60 of the transaction is subject to GST, which is the lower of the value of services performed or payment made after the implementation date. A continuous supply of digital services straddles the implementation date and is subject to the transitional rules when invoice is issued or payment is received before 1st January 2020. The services or part of the services are performed from 1st January 2020, and the services are performed pursuant to an agreement made on or after 19 February 2018, but before 1st January 2020. Examples of continuous supply of services include online subscription to a database or streaming of music or video. In other words, in the context of OVR, the term continuous supply simply refers to services performed over a period of time. The key thing to take note of for a continuous supply of services that straddles the implementation date is we are looking at the portion of the services that are performed from the implementation date of 1st January 2020. Even if the invoice is issued or payment is received before 1st January 2020, the portion of the service performed from 1st January 2020 will be subject to GST. Where the amount invoiced differs from actual payment received before 1st January 2020, GST is to be accounted for on the higher of the two amounts to the extent that it is for the services performed from 1st January 2020. The portion of the service which GST is applicable on should be filed in the overseas supplier's first GST return. To illustrate the transitional rules for a continuous supply of services, we will look at example 7. Company F is registered under OVR and supplies online media streaming services to a non-GST registered customer in Singapore from 1st November 2019. Company F issued an invoice on 1st November 2019 for its services for the period of 3 months. Company F received payment from the customer on 1st December 2019 for a period of 6 months and decided to treat the additional 3 months of consideration as prepayment for its services. The transitional rule states that the portion of the service performed from 1st January 2020 will be subject to GST, and where the amount invoiced is different from the actual payment received before 1st January 2020, GST is to be accounted for on the higher of the two amounts. Since payment received is higher than the invoiced amount, GST has to be accounted on the payment received for the period of service performance after 1st January 2020. In other words, the supplier has to account for GST on the period of the service performed from 1st January 2020 to 30th April 2020. Lastly, we would like to briefly highlight the overall timeline for the implementation of GST on imported services and wrap up the seminar by reviewing what overseas suppliers and marketplaces need to do to prepare for OVR. The important dates are highlighted in red font. As explained in Part 4 of the seminar on the Transitional Registration Rules, The due date for overseas suppliers to notify IRAS of their registration liability under OVR can be as early as 1st November 2019, depending on their basis of registration and the earliest date of forecast. GST-registered overseas suppliers are required to start charging GST on their supplies of digital services to non-GST registered customers in Singapore with effect from 1st January 2020. With these timelines fast approaching, overseas suppliers and marketplaces are encouraged to check early whether they are liable to register under Singapore's OVR regime if they have not done so. Overseas suppliers are strongly encouraged to register on time to avoid any penalties from failing to notify IRAS of their GST registration liability by the due date. Overseas suppliers and marketplaces that are liable to register should also start allocating sufficient resources to IT system changes to comply with the OVR regime's requirements. These IT system changes take time, and key elements such as fails to allow customers that are GST registered to provide their registration number, and system logic to decide whether a customer belongs in Singapore based on the proxy categories must be in place to be compliant with the OVR regime. Overseas suppliers that need clarification or approval for OVR issues should also write in early to IRAS via email at gst@iras.gov.sg. Examples include clarification on whether a supply of digital services is within the scope of the OVR regime, or approval to charge GST on the supply of non-digital services that are supplied together with a principal supply of digital services. Electronic marketplaces should also write in early if they wish to seek approval to charge and account for GST on B2C digital services made on behalf of both overseas and local suppliers through their marketplace. Overseas suppliers and overseas marketplaces that would like to register under the Simplified Pay-Only regime can do so via the link shown in the slide. Before filling up the form, please note that you are required to attach a declaration form signed by your director, partner, or sole proprietor, and a notarized certificate of incorporation at the end of the form before submission. All the required documents can be found in the registration form, except your notarized certificate of incorporation. With that, we have come to the end of the seminar on Singapore's OVR regime. We hope that this seminar has helped you understand the rules and mechanics of the OVR regime and how to get ready for it. Thank you for your time.